The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organization mentioned in this podcast.
Hello there, and welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, madness is upon us, but we're trying to sort of make sense of it all and trying to ignore it at the same time. How are things for you in software and services world?
Ian, this is the cruelest month. Tariffs, trade war, increasing UK gilts, global markets in meltdown. In terms of my results this week, not a huge amount from me. We had Serata, we had Gattaca, and we had Qualcomm, the distributor out of Germany. This feels like a sleeves rolled up time. Ian, I'm probably more interested in what you have to chat about this week, truth be told.
Well, it's been quite an eventful week for me in terms of the companies I've been looking at. I've had Pinewood, and then I've had good old Raspberry Pi, and also got entertainment value coming through from Alphawave and Big Technologies. Pinewood.AI, the software for car dealerships, everything seems to be going to plan. This one came out of the Pendragon stable, as it were, last year. It's an interesting business. Everything is a little bit sort of a phony war almost, because we're really waiting for the launch of the US market product, which will come through next year. And they will be putting that into the giant base that is Lithia in the US and hopefully selling into the throngs of US car dealerships. But they're not there yet. And at the moment, we're just sort of waiting on what's going to happen. And yeah, US car dealerships are probably a little bit mad at the moment, but it's nice to see that this company is actually sort of doing what it says on the tin.
I've got to say, Ian, I looked at that one as well, and I thought, wow, so much activity post-period end. Massive contract, and then buying the guys at Shez for the chatbot, basically.
Yeah, the chatbot deal looks good. We spoke about it a few weeks ago, and certainly 90-odd% of US car dealerships are using chatbot. I think the interesting thing, sort of attending these meetings, you try and get what other analysts are thinking about. And it's difficult not to get lost with car retailers to think, oh, it's all about selling cars. But it's not. In the UK, it's about selling services, because that's actually where you make your money. And in the US, perhaps even more scary, it's about selling finance deals. So this really isn't some kind of sort of data management business. This is about an extended CRM product suite that is able to draw in information from a wide number of sources.
And I think what you're telling us is that this was a new entrant into our world last year. Any other news from any other new entrants?
Oh, the big new entrants. We're waiting for the big one. Big drum roll for Raspberry Pi.
Raspberry Pi.
The maiden final results. Okay, it's at the lower end of where it was hoping to get to, but as a hardware analyst, I have to say I looked through it and I thought, oh, it's a bit more squeaky bum time than perhaps might first appear. But then again, also as a finance guy looking at it with a hardware background, it's all the more impressive for the fact that having gone through product launches, inventory builds, component shortages, the ups and downs that come with this industry, it's all the more impressive that it's done what it's managed to do. They're talking about a positive outlook across this year. Even Upton, the chief exec, says that they won't be launching as many new semis products this year, or that sort of device products this year. It'll be mainly sort of more sort of the add-on accessory side of things. And that these launches won't be as Q4 weighted. And of course, that brings you back having to scratch your head and thinking, well, if everything's come through in Q4, what does that say about our visibility on what the rest of this year is actually going to be like? Have we just seen a good old launch cycle and we're just in the sort of cloud nine after that? And leading from that, you have to look at the inventory level, which is $160 million of inventory for a company that last year only did $260 million of revenues.
I mean, that translates to 290 odd days from 120. Ian, can you put your hardware analyst head back on again and think, is this too much? Is the inventory build too much? Is this telling us about commercialization?
This is telling us that They've got a cash pile that they're not afraid to use it, as it were. They don't want to get things wrong.
Yes.
And this is the big concern with this business. I think we wrote about it when it was being launched onto the market. We're saying, well, actually, look at the way this business sells. This is a reseller-based business, hence the worryingly low gross margins to a certain extent, 24, 25% gross margins. And that does translate into 10% operating margins, but it still feels that this should, in terms of the feel of the meeting, what the general narrative is, it should be a higher operating margin. It should be a higher gross margin. It should be a lower inventory level. Granted, this is a business that is something on a path. It's gone from being a hobby boards business, and then it's added on the idea that you're using these products for development, and they produce some software and the way in which everything evolves around it, to the point now where it produces components and modules that should be going into volume products. It's a little bit early to be able to see that huge volumes are coming through at these end OEM products. But from everything that they are saying, where you can actually see the products coming through, and from my own personal experience, because I'm exposed to a couple of companies that use Raspberry Pi as products for development, and potentially they are going to use them for components into final devices. Yeah, this is a business model that works in the whole new way that the electronics and electricals industry is working. The whole way in which companies are designing components, systems is changing. And Raspberry Pi is playing a good part of that.
The FT did a big piece on the valuation, saying the valuation was basically just too high. I don't sense you've got any concern on valuation at all.
I think it is that classic case where the market sees, I've got the big picture, I know where this is going, I can see where the whole way that electronics market is going, where in which systems companies are designing their own chips, they're going further down into the value chain, as it were. People are spreading out. It's not just about a semiconductor company makes a semiconductor and hands it over to the market and says, there you go, do what you want with that. Because it's become so fragmented, from the foundry to the fabless semiconductor manufacturer to the consultancy companies that help the fabless semiconductor companies design their chips. And then you think, well, actually, why don't those guys, as we see within Silica, why don't they actually go and help design chips for the big industrial systems companies? And it's almost gone full circle, because if you think about where did the semiconductor industry come from, who were the Fairchilds and the Texas Instruments and such like? These were companies that made electronic systems. Now, everything's sort of fragmented, set out in one way, and then come back together again, as it were. Full circle. Very strange.
Ian, you've taken the conversation from product through to process, through to go-to-market, through to how a channel is organized. At the same time, me as a complete amateur, I'm just looking at the big inventory number, and what I want to see is some unwind. As a professional in this space, what are the KPIs that our listeners should be looking at going forward on Raspberry Pi?
It is just that inventory figure, really. You're not going to get the gross margin or anything to go up short term. It's just, is that inventory figure going to be under control? It just looks too high.
But the other thing is, you said they've got loads of cash. So as we both know, inventory equals cash. They've got loads.
If that is what the investors are happy with, that is what the investors are happy with. If the investors think that we need $160 million of inventory to generate 320, whatever $million of sales, so be it. Frankly, we're happy with that situation than if they were sitting on debt and trying to drive this business forward.
Yeah. Raspberry Pi is a bit of a darling for the UK, so I'm thrilled that you're on top of the detail in there. A company that I guess was never really a glamour, but was also based in hardware and to some extent you could say edge devices, is Big Technologies. Ian, what's gone wrong?
What's gone wrong? Has anything fundamentally gone wrong with the underlying business? The underlying business, it's a very interesting, very nice business that they're in. You provide these tags for monitoring locations of people, otherwise known as people let out of prison or not gone to prison because you put a tag on them. And going forward, also people with alcohol issues. That's an increasing market for them and a very interesting one. So the product is relatively simple technology-wise. You're out there trying to deliver a bit of service to government bodies, so you should be able to get a decent amount of margin out of them, and they do. and you should have a cash generative business model, and they do. And you should get long-term contracts, which they do. I think they overplay it when they talk about SaaS-like, because at the end of the day, this is a leasing company. Effectively, you've got bits of kit and you've got some software that you flog out. It's not like we're using the whole idea of cloud computing lies at the heart of it or anything, or anybody's plugging in APIs here, there, and wherever. Nice enough business. Those high margins, 80% gross, do look a little bit sort of how long can those really be achieved once everybody comes into the market and once you've gone through sort of one or two contract renegotiations and people start thinking, hold on, what am I paying for here?
But if I was in charge of Domino's Pizza, this is just the product I want from my delivery guys.
I don't think we go that far, thank you. You can always just put them on the boat bed. But the issue has been Sarah Murray, the chief exec, and looking into the disclosure as to how much she owned or controlled of the business in terms of shareholdings, and it might appear that substantially more than was disclosed at the float stage. She has been shown the door, and it looks like there is going to be a lot of lawyers' fees. I just find it odd that this has gone through, really. The thing that really got me with this company, though, although however much I liked it as a business model and where it could go to, and the cash generation, is the fact that the share-based remuneration was just ridiculous. So in 2023, you have revenues of around about 55 million. You end up with a share-based payment of 11 million. So that's 20-odd%. That doesn't really seem right. Okay, you can say that it's not a cash charge and it is a calculated charge, but it was something that they would have had to work out ahead of time at the float stage, thinking this is what we're going to charge all the other shareholders. Gives you a fair insight into the mindset of this management team, I think. I can understand why the investors went in and said, okay, this is a brilliant company, great market, growing market, visibility, what have you. But really? I mean, that just seems crazy.
As I read through it, Ian, I was reminded of our conversation last week. I'd love to put a link to it, where you discuss the challenges of DD for public market investors on new AIM companies. And I thought, wow, bingo, Ian's got it. This is such a shining example of exactly what you were talking about.
Well, there are two sides to how good an example it is. I mean, on one side, it is my repeated whining about share-based remuneration not being an issue in itself, but being something that is an indicator of something else, most notably, as we saw recently with Palantir. A huge number. You can sit and think about it all you like. You're not going to get an answer out of it, but it's pointing you to there's something else going wrong or there's some other dependency. And that's what it's done here. And looking at the shareholdings, well, you have the 25% or so that she disclosed. And then we have the 40-odd% figure that it might appear to be turning out to be. But the problem lies into historic dealings that she made in previous professional roles, should we say. And there's been a lot of noise about this. And whether it's true or false, I can't see how, if you're an investor and you look at what the noise is, and then you look at 20-odd% of the revenue figure going out as share-based remuneration, not in cash, in dilution, how can you not sit there and think, perhaps it might be worthwhile standing back from this one?
Yep.
And it poses an interesting question for the investors who are still in there, because in order to have gone in there with that charge going through the books every year, you would have to have said, okay, I don't care about this shareholding thing for Sarah Murray because I believe she is fundamental to the business. Where does that leave you now as a shareholder? Because you've had to sort of tie yourself firmly to the Sarah Murray mast by saying, I'm happy with that level of share-based remuneration because she's so important. If she's so important, where's the business going to go now?
You've left us with a conundrum. I'm also reminded, though, this week of Eagle Eye, the founding CTO, he stepped down. So there is, in terms of the life cycle of a company, the period when the founder has to leave, and that will come in a number of ways and through a number of paths. So hopefully they have created a company that can not just survive, but thrive without them. I don't know where big technologies is on that development curve. I confess I've met Sarah Murray several times. She is a very smart lady, knows exactly where she wanted to take the company, which was increasingly down a technology path, which I confess it was a very exciting narrative there. I find it very disappointing that it has come to this.
Yes, it's a shame, to say the least.
Is there a better story in Alphawave, Ian? Are you going to regale us with joy?
Am I going to regale you? Well, in that the shares have gone up over 50% because Qualcomm has come sniffing. I mean, Alphawave is possibly just as contentious as big technologies. It came to the market being heralded as this is a fantastic semiconductor IP company. The UK market understands semiconductor IP. That's why we're bringing it to the UK market. We're going to raise a shed load of money and we're going to go out and spend the shed load of money on businesses that aren't semiconductor IP. And then we're going to change our name to Alphawave Semiconductor. Not the slickest action. I think the whole thing was very much that whole sort of 2020, 21. The market went ahead of itself, frankly.
Yes.
Although the founders, the North American guys, the techies, can be a little bit difficult to get your head around, and we have to admit that they're perhaps not natural capital market interactors, and specifically not very good at interacting with the UK investor base. I think they got caught up in the whole process, as it were, and they brought on board a CFO from a banking background, and they went out and they raised a lot of money and they spent a lot of money. I don't think that when we look at the business now, what is Qualcomm interested in? Qualcomm is interested in the business that came to the market that these techie guys had in the first place, which is the serializer, deserializer, how to handle data at very high speed within a system, within a computing device or a communications device, such as between data within a data center. These guys have been doing it for years. Qualcomm is going to have to be interested because there aren't that many people who've got leading edge expertise and who aren't within a major semiconductor company. They've got a couple of weeks to express some kind of proper interest. Where the shares go if that walks away, I'm not quite so sure. But it's also interesting that after this announcement, the news comes out, shall we say, that ARM was apparently looking at it and decided not to buy it. One would assume for exactly the same pieces of technology. Although the question that I'm left scratching my head about is that we've just got two of the largest semiconductor IP companies looking to buy another semiconductor IP company. Now, we had an awful lot of noise about what might happen if ARM was bought by NVIDIA, about who owns IP and who has rights to IP. And we also have the issue that Qualcomm is currently in legal dispute with ARM about the use of IP. I just try and scratch my head and think, why didn't they just license it?
Good question. Sometimes you just want to own the IP.
Yes. Some people have the egos and the view that they've got to control it. And I think that possibly is the case, that frankly, if you're going to spend a few tens of millions, you might just as well as spend $1 billion to get this IP. At least then you have control over it. But it's an odd one.
Ian, can I take you away from your sector for a quick minute? The market reaction since the Trump tariffs came out has been, you could say, well, uniformly weak. But there's been a lot of concern in terms of the hardware sector. Simply physical products carry the tariff. But in addition to that, we, as in the UK, we have a trade surplus with America on the hardware side. Do you have any general concerns, or would you flag anything or any company up to investors and say, in these times of uncertainty, have a look at the following? In terms of the sort of the software and IT services side, we're looking at America there has a trading surplus, so we feel a little bit more comfortable and relaxed. And what the EU might use, and of course the UK, is the digital services tax as being our ability to hit the Americans over the head. But in terms of hardware, do you have any specific guidance there for our listeners?
I think when we look at, I suppose it's mainly the sort of electricals companies that are exposed to this. It is going to be difficult, but how long is all this madness actually going to last is the other question.
4 more years.
4 more years. I'm not sure it's going to last 4 more years. I think there is a lot of sort of saber rattling going on. And a lot of these businesses certainly in the higher end side of things, when you talk about the electricals businesses, if the whole world is having to face these tariffs, what's the problem? You're just going to have to say, right, GDP is not going up, GDP is going down, or the top line is going down. Trying to make a relative call is next to impossible, really. It's nice that we've only got 10%, whereas main competitors may well have 20%. But a lot of the decisions in terms of high-end electronics, high-end electricals, 5, 10, 20%, it's not actually the cost that's making the difference. Certainly not on the product. You then have implementation and the ongoing life cycle costs. There's so much more to costs of using devices than actually the hardware itself. I'm not drawing any firm conclusions, I'm afraid, other than just happy that I'm not a penguin and being victimized.
Oh, yes, of course. Penguin Libra. Very good. Ian, have a super weekend. Once again, many, many thanks for sharing all of your insights.
Well, hopefully a bit more excitement for you in the next few weeks.
Brought to you by Progressive Equity.